I've been hearing a lot of advice out there from financial experts to tell people to claim Social Security as early as possible because you don't know how long you're going to live. So take it now when you're young and healthy, or you don't know if Social Security is going to go bankrupt or not. But what if I were to tell you that for high net worth retirees, claiming early could potentially cost you several hundreds of thousands of dollars of lost income and also negatively impact your investment portfolio over time? So in today's episode, we're going to dive into 9 reasons you might consider delaying your Social Security as long as possible. My name is Kevin Lau. I'm your host of the Planning for Retirement podcast, and I'm also the owner and lead financial planner at Imagine Financial Security. We help individuals over 50 that have accumulated at least $1 million maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to follow the podcast and make sure to subscribe to our YouTube channel. We're putting out weekly retirement-related content specifically designed for you, PFR Nation. So before we dive into this topic today, there are 2 big stories that are developing. I'm recording this on May 22nd, so Thursday, May 22nd, that I believe are important to all of you that are listening to this episode. First and foremost, Moody's, one of the 3 major credit agencies, has downgraded U.S. credit from AAA to AA, okay? And they are following suit, essentially S&P 500, or the S&P, they were the first ones to downgrade U.S. credit back in 2011 from AAA to AA, and then Fitch in 2023. So now all 3 rating agencies do not have the United States as a AAA credit issuer, okay? This is a very, very big deal. And some of the issues that they have cited, some of the issues that Moody's cited in their publication, number 1, rising national debt, which we've talked about, $36 trillion today, potentially climbing upwards of 134% of GDP by 2035. That's not good. Number 2, large annual deficits without any measures to curb them. I truly don't know when the last time we've had a balanced budget. I believe it was in the Clinton era in the mid-90s. Okay, so that's been a long time, and the debt is piling up. Okay, and now interest rates have gone up. So therefore, the cost of our government to borrow money from investors and other countries that are investing in the U.S. has now gone up as well. So ultimately, as interest rates have gone up, the cost of borrowing, the cost of our government doing business is also going up as well. So there were some significant concerns. The market reaction was a little bit of a mixed bag this week, overall negative. But ultimately, the big thing I'm looking at, and I'm going to share my screen here in just a second, the big thing I am looking at is the impact on the 10-year Treasury. Okay, here's a chart that goes back to a little bit before 2016. And it shows interest rates at that point in time were about 20 or 2.5%. And obviously, kind of stayed in that 2 to 3% range for quite a while. And then in 2020, ultimately, interest rates were cut significantly during that period of time because of the pandemic and brought below 1% for a period. And then inflation started to kind of tick up a little bit. Interest rates started to go up. And then in 2022, all of a sudden they surpassed 3%. And then that is when the Fed actually increased the Fed funds rate. So they began to raise interest rates to try to combat inflation. So now interest rates, the 10-year bond is a little over 4.5%. And it's come up. This is probably 2025 right here. It's increased significantly so far in 2025. So the reason that's important for all of you listening in PFR Nation is that yields have gone up. So that is a benefit. So ultimately, the coupons that you're collecting on new issues today, you're going to collect a little bit more in interest income. Maybe you have a little bit more concerns about the United States government repaying that par value back when those bonds mature. But I don't think we're at that point at this point in time. The bigger concern is existing bonds that you may have purchased over the last couple of years because interest rates have gone up really since 2022. The impact of those bond values, the prices are going to go down. So interest rates and bond prices have an inverse correlation to one another. So what that means is as interest rates go up, the value of your bonds go down. And if you don't hold those bonds to maturity, if you're forced to sell early, that could negatively impact your investment portfolio. So very, very important to kind of look at these at the 10-year yield and also even the 30-year yield, because ultimately both of those have gone up this year. Even the 30-year has significantly jumped, I think a little bit upwards of 5.1%. So again, those higher borrowing costs for the U.S. government could potentially impact growth generally in America. But certainly for you as a retiree, if you're investing in credit in the U.S., you could potentially expect a slightly higher interest rate. And certainly you would require now a higher interest rate because the U.S. is no longer AAA across the board. But more so, For all of you retirees or folks that are approaching retirement that have a significant portion of your portfolio in bonds and fixed income, you've probably seen a little bit of volatility in your portfolio this year. And certainly with our clients, with our practice, we're seeing that too. Our clients are not immune to this risk as well. We do have kind of that core staple 60-40 portfolio, 60% in equities, 40% fixed income. If you're not strategic on that fixed income side, if you're too long-term in your duration, that could significantly impact the value of those bonds. Again, if you do not hold those to maturity, you're going to be forced to sell potentially at a discounted price, because who's going to want to buy your bond that's paying a lower yield relative to what they can buy in the open market today? So very, very important to kind of look at this. But I think the other reason it's important is because this is coming off the heels right now of the One Big Beautiful Bill Act, the OBBBA or OBA. I don't know if that would be the correct term for it, but let's call it the OBA, has now passed the House. Okay, very, very narrowly. Okay, I think it passed by one vote. So mostly partisan. There was a narrow passage of this bill. And I bring that up because this is absolutely going to impact long-term our ability to pay some of the interest on our debt, because ultimately the revenue that the United States generates from tax revenue, okay, and also relative to our expenses from debt, that is going to impact our ability to pay back that debt, okay? So right now we're kind of looking at this one, and it's really hard to figure out exactly the long-term impact of this bill. I mean, you can kind of look back to 2017, the 2017 Tax Cuts and Jobs Act, okay? And so that's what I did. I looked back to the 2017 Tax Cuts and Jobs Act because I was trying to figure out, okay, because on one hand, revenue is expected to go down. Okay, so tax revenue is going to go down. So where are we going to find the money to pay for that lost tax revenue to support the interest payments on our debt? Well, one way to do that is by increasing growth. So GDP going up. So the Tax Foundation analysis looked at GDP, and the expectation on this new bill, if it does pass in the Senate, is going to increase GDP in the long run by about 0.6%. So not significant, but certainly something. So therefore, they're expecting that tax revenues are going to go down by 4.1 trillion from 2015 to 2034. So pretty significant, but ultimately on a dynamic basis, once you take into consideration potentially growth that's kind of spurred from these tax cuts, both corporate and individuals, that would still result in a reduction of revenue collected by the US government, down from 4.1 trillion down to about 3.3 trillion. So net, even with the expectations of growth, according to the Tax Foundation, okay, and this, I wanted to use the Tax Foundation because I think they try to be nonpartisan. I think they probably lean even a little bit more conservative than some of the other publications, like let's say the Brookings Institute, okay, but they're also solid. But overall, the bill is going to prevent a tax increase on 62% of taxpayers. Okay, so that's the big one. So if the bill doesn't pass, 62% of individuals, US taxpayers, you all listening to this, are going to experience an increase in your tax rate. Okay, so if we look at this next slide, this illustrates tax rates, the average tax rates. Okay, and this is really important to note as well, is that you've got your marginal tax rate, which is your top tax bracket. So you kind of think of the tax brackets. We've got 0%, 10%, 12%, 22, 24, okay, 32, 35, 37. That's your marginal tax bracket. Okay, so that's the top rate that you would pay on any income in that particular bracket. But ultimately, we have a tiered system. So some of your income is taxed at 0, some is taxed at 10, some is taxed at 12, et cetera, et cetera. So this is looking at the average tax rate in the bottom 50% of earners, the top 50 to 25%, top 25 to 10, 10 to 5%, 5, and then the top 1%. So ultimately, across the board, you see the impact from the 2017 Tax Cuts and Jobs Act, reduce the average tax rate across the board for just about everybody. Okay, obviously there's outliers depending on where your income sources are coming from, what deductions you may have qualified before. If you're itemizing aggressively, maybe you were impacted negatively. Okay, but as a whole, if you look across all U.S. taxpayers, most people benefited personally from the Tax Cuts and Jobs Act. Okay, and the new legislation that's put out, like I said, I went back to 2017 because I wanted to really think about, okay, if we're going to have a reduction in revenue, we already have this issue with our U.S. credit. If we're going to have a reduction in revenue, how are we going to pay for that? And really the obvious one is increasing growth. Okay. Another one you could throw in there is with DOGE, cutting expenses. And I think that's definitely a fact. Cutting our costs, unnecessary fat, that could absolutely help our ability to tackle this debt issue. But what it doesn't really take into consideration is potential GDP impact. And really, if you look back from 2017, once those tax cuts went into effect in 2018, we did have a slight uptick in GDP. But after that, it did go down. 2019, GDP went down. 2020, GDP went down. But it's hard to really peg whether or not the tax cuts helped or hurt GDP, because then what happened was the pandemic happened, 2020, and we had to print so much money in 2020 to stimulate the economy, to prevent our economy from slipping into a recession or worse, a depression. So time is going to tell on this one, okay? The big, beautiful bill, okay? I'm all for tax cuts, okay? Personally, I'd rather have paid less in taxes. And truthfully, I look back at my personal tax return back in 2017 relative to 2018. I was one of those individuals that did benefit from the tax cuts, okay? So, of course, I'm for this, but I'm also kind of looking long-term at the viability of our country and sort of people looking at investors, foreign investors looking at the U.S. as like the safe haven of sort of like the staple of safe money. That is in jeopardy at this point in time. And so it's such an important topic to really dive into over the next several months and several years in terms of what the impact of this particular bill is, especially if it actually goes through the Senate, which I think there's a good chance at this point in time. I think there's a good chance it's going to go through the Senate in some form. But again, we need to figure out cuts to spending. That's going to be the DOGE part. I mean, increased revenue from tariffs could help as well. But I mean, ultimately, that could hurt GDP from that standpoint. And the third leg of the stool in terms of tackling this debt issue is increased GDP. And I think that's really where the Trump administration is trying to lean in and say, hey, increase in growth, increased revenue from tariffs are going to pay, and then the cuts to spending are going to pay for these tax cuts that lost $3.3 trillion of revenue that I referenced earlier. So such a critical time in American history, American politics right now. I'm obviously rooting for our country. Whatever transpires, whatever they believe is in the best interest of our country, I'm going to trust that. But ultimately, for you all, PFR Nation, we need to really think through the decisions that you make from an investment perspective, from a diversification perspective, looking at, hey, U.S. should be part of the equation, but should we also look at other countries as well from an investment perspective? I've seen a lot of individuals super biased on U.S. equities because if you look back since 2009, that's been the top dog. If you look over the average returns over the last 15-ish years, U.S. equities have been the top dog. International equities, emerging markets have been lagging behind. But ultimately, I think this plays into the story and into the narrative of diversification, international exposure. Okay, looking at your fixed income and saying, hey, you know what? Maybe we have U.S. bonds, U.S. treasuries in there, but maybe we also introduce some corporate bonds. Maybe we also introduce foreign bonds as well, which we've also done in our client portfolio. So critical from an investment perspective, but also very critical for Social Security, which is what our topic is going to be today. Because one of the concerns for a lot of folks in terms of, hey, is Social Security going to be around in 20, 30 years? A lot of people have this narrative in their mind that Social Security is going to be going bankrupt in 2033, which technically speaking, the trust fund, if nothing changes related to the Social Security trust fund, that is set to go to zero by 2033. So therefore, the only way we're going to be paying Social Security benefits is through payroll taxes, okay? So payroll taxes fund about 80% of the current benefit. So if you kind of use simple math there, basically Social Security will need to be cut by 20% unless something changes. That would involve some of those things we mentioned earlier or potentially raising taxes, okay? And that's why I'm looking at the tax cuts bill and I'm just kind of thinking in my mind, I'm like, they're going to have to raise taxes at some point. I don't think any politician wants to put their stamp on raising taxes. But if we're going to solve for this gap, this shortfall in Social Security, they're going to have to figure something out. But again, this is potentially years, decades down the road. For those of you that are on the brink of a Social Security timing decision, I think I want to start with this Gallup poll that I was researching as part of my preparation for this one. Is that, so this Gallup poll, okay, so for basically in simple form, the Gallup poll they did started 23 years ago for this particular retirement study. And essentially, when they first interviewed these individuals, all of them were in this 45 to 60-year-old range. Okay, so 23 years ago. And they asked those individuals their expectations on Social Security once they got to retirement. And 35% expected Social Security to be a major source of income in retirement. So definitely the minority. Okay, 35%. Fast forward 23 years, that same cohort reported that 58%, so 58% of that same cohort reported that Social Security is actually a major source of retirement income. So the expectations of what people think Social Security is going to deliver relative to what it actually is delivering it really kind of supports this narrative that we're going to really talk about today, which is this idea of delaying Social Security as long as possible, trying to maximize your Social Security benefits for you and or your spouse, if that's applicable. And so that's why I really wanted to do this episode, because we did an episode back on it was episode 68. It was 9 reasons to take Social Security early. Okay. So there are definitely reasons that you may want to take Social Security early. And some of them are related to what I mentioned at the beginning of this episode, related to you don't know how long you're going to live. And you don't know ultimately what's going to happen with the Social Security trust fund. Are they going to have to make some significant changes to Social Security later on? But again, I kind of look at this Gallup poll. People have been pessimistic on Social Security for decades on end. Okay. And if you kind of follow that narrative and try to claim as early as possible because of some of those reasons that are not guaranteed, you could potentially miss out, like I said, on hundreds of thousands of dollars in lifetime benefits from Social Security. So super important, but just kind of some block and tackles on Social Security basics. In order to qualify, you need to have 40 credits. So that's typically achieved by working for 10 years. And you have what's called a primary insurance amount, which is essentially the amount that you are subject to receive at your full retirement age. And so for most individuals, if you're listening to this, or for most individuals that are born after 1960, so if you're 65 today, your full retirement age is likely going to be 67. Okay. So it might be a little less than that. It might be 66 and some change if you were born a little bit before 1960. But for most individuals that are still listening and that have Social Security timing decisions in the pipeline, age 67 is going to be your full retirement age. So that's when you are eligible to collect your primary insurance amount. But you can also collect benefits a little bit early. So you can collect benefits as early as 62. Just one thing to note on this one is that when you're paying into Social Security, there's something that's called a Social Security wage base. Okay. And so the Social Security wage base is taxed at 6.2% for employees and 6.2% for employers. Okay. So for a total of 12.4% of your income, up to that Social Security wage base is going to be subject to these payroll taxes, essentially. Okay. If you look at the chart here that I put on my screen, if you're watching on Spotify or YouTube, if you look at 2025 down there, you can't see it because there's some icons that are covering, but it's the wage base is $176,100. So this is per person. This is not adjusted gross income, combined adjusted gross income. This is an individual's wages. Okay. So if you make $100,000, all of that $100,000 is going to be subject to these Social Security taxes and Medicare taxes. Okay. But if you make an excess of $176,100, only 6.2% is actually going to be subject to these payroll taxes for Social Security. Okay. It kind of sort of paints part of the picture and like part of the potential challenge, I think. And one of the likely solutions is that they're going to increase the wage base on Social Security. Because if you kind of look at this, $176,100, those individuals are paying the full 6.2%. But if you make 2 times that amount, let's say you make around $350,000, really effectively, you're only paying about 3.1% Social Security taxes. So it kind of actually hurts you to make less money in this scenario. So it's kind of an interesting dynamic that Social Security is actually technically like a welfare benefit, but ultimately it actually hurts the taxes on the front end when you're accumulating. It actually hurts the lower income. I'm not going to say 176,000 is lower income, but you kind of get my drift. Folks that are making higher income are paying less in Social Security taxes. And that's an interesting dynamic. So I think that's a very likely solution later on to shore up this gap between the 80% and 100% is to essentially increase the wage base. Because historically speaking, it's just increased with inflation. Let's go back to 1995. Okay. So let's use a 30-year time horizon. The Social Security wage base was $61,200. And you can see it just adjusts with inflation over time. Okay. And so I think, like I said, this is a very likely solution later on to the Social Security issue. But certainly you can claim as early as 62. But if you did that, you're going to have a reduction of benefits. Okay. So if you claim before your full retirement age, whenever that might be, and this is a nice little chart that illustrates that. So if you claimed at 62 and your full retirement age was 67, the reduction for you will be 35%. Okay. You'll have a 35% reduction to your Social Security benefit. So that's significant. So if you certainly by waiting, you're not claiming Social Security, obviously. So you have that lost income that you could have otherwise received as early as 62. But this is why it's such a critical decision, because once you lock that in, you're locked into that lower benefit for life. Now, there are some exceptions. You can at your full retirement age, let's say you claimed at 62, once you hit full retirement age, you can elect to stop your benefit. You can say, hey, you know what? This is a one-time opportunity to stop my benefits, and then I'm going to get those delayed retirement credits up to 70. So you do have some flexibility there, but in general, you're going to be locking in those benefits for life at that lower rate. So very, very important. Let's talk about average monthly benefits right now. So if you look across the board for all recipients, it's about $1,840 per month is the average Social Security benefit. For retirees, it's about $1,900, a little over $1,900 a month. Okay. And this is per person. So, if you have a married couple, maybe that's a little bit higher than that, obviously, because depending on, if both worked full time and, et cetera, there's a lot of variables there, but you kind of get the drift of a little less than $2,000. But this is the average. Okay. And so in order to receive the average, you had average earnings. However, a lot of you that are listening to this podcast, you have above average earnings, and you've had above average earnings for many, many years, potentially decades. Okay. So actually, if you look at the maximum possible monthly benefits that you can receive at full retirement age, it's actually over $4,000 a month would be your primary insurance amount at full retirement age. Even if you claimed early at 62, you could collect up to $2,800 a month. That would be the maximum possible benefit in 2025 when I'm recording this. And then if you delay it until 70, you get some of those delayed retirement credits, which we'll talk about later. And that monthly benefit in 2025, the maximum possible benefit you can receive is $5,100 per month. And that's, again, for one individual. If you have two individuals that are making, let's say, high income earners, maybe you've got that $4,000 at full retirement age and then an extra $2,000 or $3,000. You can see this. This is why 58% of the folks in the Gallup study reported that it represents a significant portion of their income. And a lot of our clients, even though they are technically higher net worth individuals, they are relying on Social Security for a good chunk of their income because it's paying them $5,000, sometimes $6,000 per month combined between a married couple. That's a pretty nice fixed income. I mean, you would need, if you're collecting, let's say $60,000 per year on $1 million portfolio, that's a 6% rate of withdrawal. Okay. And that's not even taking into consideration the slightly difference in taxes on Social Security relative to other income. So again, a 6% rate of withdrawal on $1 million, that's pretty significant. That's pretty aggressive. This is why this Social Security benefit is so powerful. And I looked at this case here with one of our clients. We'll call them Jack and Jill just for this case study. There's actually a client we were meeting with yesterday. And just for fun, I wanted to kind of look at like the combined Social Security income for their lifetime, okay, for both Jack and Jill. And this assumes several different scenarios, early as possible down here. So both of them claiming at 62. Current strategy, that would be full retirement age for both of them. That's the same as the full retirement age one. And then both claiming at 70. If hypothetically, let's say they both claimed at 70 to get the maximum possible benefit, and they lived until 85 for Jack and then 90 for Jill, assuming a 2% cost of living adjustment. So that's one key factor, is that Social Security does increase over time. So each year you get a cost of living adjustment. Whatever the CPI is, that's what your benefit is going to increase by. So in this scenario, combined, assuming a 2% cost of living adjustment on average, they received a combined $2.3 million from Social Security, okay, by taking it from 70 up until Jack's age 85 and then Jill's age 90. Again, this is why the power, and this is what I mentioned earlier when I let off, if they claimed that as early as possible, their cumulative benefit is closer to about 1.8 million. That's about a $500,000 reduction. Obviously, this assumes longevity, and that's part of what we're going to talk about into the reasons of delaying versus claiming early. But this just shows you the potential power that delaying Social Security can have, and ultimately Social Security as a whole can have on your retirement income. But with that as the backdrop, why don't we jump into the 9 reasons why you may want to consider delaying Social Security? All right, why don't we kick it off with the low-hanging fruit here? So let's say you or even your spouse is still working. So obviously, if you have that income, whether it be from part-time income or full-time income, self-employment income, whatever it might be, maybe that covers a good chunk of some of your basic necessities. And maybe you can supplement that income with some withdrawals from the portfolio. That could be absolutely a reason to continue to delay that Social Security. Maybe you retire at 62 and you're eligible for Social Security, but you don't want to take that 35% haircut. This could be a great reason just to continue to delay that Social Security, at least until primary insurance age, or potentially even until 70. Now, one of the other things to consider is this idea of this retirement earnings test. So if you did, let's say you did claim Social Security, and let's say it was at, let's say 62, but then you're actually earning some income. Well, Social Security has what's called this earnings test. And so if you earn over with your wages, if you earn above a certain threshold, you're going to be subject to this retirement earnings test. And therefore, what happens is Social Security they're going to reduce your benefits until you hit full retirement age. Like I said, most of the time it's at age 67. It's not a permanent loss in those benefits. Essentially, what they're doing is they're actually building up your benefit base even more over and above what your current primary insurance amount. And then once you hit full retirement age, then you'll probably receive a step up or an increase in your full retirement age benefit at that point in time. But ultimately, again, if you don't need the benefit and you don't have to be subject to this retirement earnings test because you can go ahead and delay those benefits, that could be valuable to you. The second thing is obvious too, but it's a higher guaranteed monthly benefit amount. And I think the big one here is we already talked about from age 62, if you claim early, you have a 35% reduction approximately in your primary insurance amount. And I say approximately because maybe your full retirement age is 66 and 2/3 or 66. There are certainly a lot of you that are probably listening that are in that sweet spot as well. But the majority of you, it's going to be 67. So therefore, a 35% reduction of income. But once you hit your primary insurance amount, you can continue to delay your Social Security benefit. So you don't have to start your benefit at age 67. You can continue to delay that. And each year you do, you're going to receive an 8% increase in your payment, in your benefit amount up until age 70. I don't know a lot of other safe investments that are providing that kind of rate of return. Now, of course, it's not as black and white as it seems. Okay. You do need to weigh the downsides of doing so. Ultimately, foregoing benefits between 62 and 69, as an example, might result in a much higher rate of withdrawal early on, which, depending on what type of market you retire into, may be bad for your long-term longevity of your portfolio. So you need to weigh the pros and cons of not only an increased Social Security payment amount, but you also need to coordinate that with withdrawals from your investment portfolio. So this chart that I'm looking at here actually shows the break-even point for cumulative Social Security payment. So I did want to illustrate this right off the bat because, yes, you're going to receive a higher guaranteed monthly amount, but ultimately you missed out on payments for a period of time. And let's say you started at full retirement age. Let's say in this example, someone started at age 66. Obviously, with the orange line here, you didn't receive any benefits until you hit 70. So that's the first time you received a paycheck. So it's going to take a little bit of time, even though you're receiving a higher monthly amount, to cross over and receive a higher lifetime Social Security benefit. So in this case, the crossover point actually happens at age 83. So certainly you need to really consider that, hey, do you plan to live until 83? And we'll talk about that a little later on. But I think this is a good example to kind of show you, yes, there are some benefits to delaying in terms of a higher monthly amount, but it also resulted in not receiving income for that period of time, depending on when you could have claimed Social Security. Number 3 would be longevity insurance. Okay. And I say this sort of in the same context of what an annuity does. Now, a lot of people have negative connotations, negative affiliations with annuities. They hear the word annuity and it's like a 4-letter word. And, rightfully so. I think a lot of these annuities are sold inappropriately, by agents that are not financial planners. They're basically product pushers. But a lot of folks that have annuities love what an annuity does. Okay. And most people, even if they don't have an annuity, a private annuity, they like what an annuity does. So if I were to explain to someone, hey, at retirement, do you want to receive income from an uncertain source or a guaranteed source that's going to pay you as long as you live, regardless if it's until 80, 90, 100, 110, whatever it might be? Most people would say, oh, I want that. That's great. Well, that's what an annuity does. Okay. That's exactly what an annuity does. It provides that lifetime income. So we call this longevity insurance. Like I said, most of those break-even points happen in the 80s. So delaying Social Security, like we just looked at, is going to happen. That break-even point is going to happen somewhere between 80 and 83. Well, listen, I don't know about you, but I know plenty of people that have lived well past 83, even well into their 90s. My wife's grandmother lived until 98. We have several clients whose parents are living in their hundreds. Okay. If you look at this chart that was published on Social Security's website, it actually shows the life expectancy based on your age. So if you are a 60-year-old male, your life expectancy is exactly 80.4, according to them. Okay, so 80 and a half. If you're a female, it's about 83 and a half. If you are 65, your life expectancy is another 17 years, so about age 82. And if you're a female, it's about age 84-ish. Okay, so again, Social Security's life expectancy tables syncs up with that break-even point. Obviously, the folks that are doing these Social Security calculations and the life expectancy calculation, these are actuaries. They have it down to a science in terms of age and health and sort of how long people are living in America. So they're not dumb. But ultimately, I'm talking to you, PFR Nation. A lot of you folks that are listening are a little bit more educated. You guys take care of yourselves. You take care of your health. You have access to maybe better health care. You have access to better medicine. And so therefore, the life expectancy for a lot of our clients, I would say, is a little bit higher than what they publish on the Social Security website. Okay, so take that into consideration, your own life expectancy. But by delaying Social Security, you provide yourself with a larger annuity stream, because that's ultimately what Social Security is. It provides you with a larger annuity stream to provide you that longevity insurance. And the great part is with Social Security is that it increases with cost of living every single year. So not only by delaying, you have a larger starting point, but then that starting point increases by the cost of living adjustments based on the consumer price index increases. So that's very different than private annuities. A lot of private annuities, they may not even have an inflation protection built into that annuity stream. It's just a fixed amount. Or maybe they'll pay a little bit of an inflation rider if they're able to. But ultimately, if they go through some tough times actuarially or interest rate wise or investment wise, they could absolutely cut those inflation riders. Whereas Social Security, it increases with the CPI every year. So very, very great longevity insurance protection. Okay, number 4, spousal and survivor benefits. Okay, so we talked a little about the benefits earlier around full retirement age and your primary insurance amount. Well, what if you're married? What if your spouse stayed at home for 25 years to raise kids or 20 years to raise kids and then got back into the workforce and maybe they didn't really build up a very high primary insurance amount for themselves? Or if they're married or if you're married, you may be eligible for spousal benefits. You could also be eligible for survivor benefits too, but let's talk about the spousal. So the spousal, essentially what this allows you to do is when you hit your full retirement age, assuming your spouse, who's also eligible for Social Security in a higher amount, is claiming Social Security, you can claim up to 50% of their primary insurance amount at your full retirement age. And the same rules apply if you take it earlier. There's a reduction in benefits, but you cannot delay spousal benefits past your full retirement age. So that's important to note, is that if you are eligible for spousal, you're better off just claiming it at full retirement age. Okay. Obviously, no, I shouldn't say obviously, but your spouse has to be claiming benefits. So if your spouse is younger and they have not yet hit full retirement age and claiming benefits for themselves, you cannot start spousal benefits just yet. Okay. But there are some cool strategies where you could potentially start with your own benefit, even though it's lower, and then switch over to a spousal once your spouse starts Social Security. But the key here that I want to hit on is this idea of survivor benefits. Okay. So if there is that scenario where one spouse has a smaller benefit than the other, okay, well, one of the things that you may want to look at is maximizing the higher of the two benefits. So let's say Jack has a higher benefit than Jill. Okay, so Jack's benefit's $4,000, Jill's is $2,500. Okay, so in that scenario, Jack would want to claim $4,000 and Jill would want to claim $2,500 because she wouldn't want to do spousal because 20 or 50% of the primary insurance amount might be around $2,000 versus $2,500. So she's better off claiming her own. Well, if Jack predeceases Jill would then step up to the higher amount of that $4,000. But what if Jack had the opportunity to increase his benefit from $4,000, maybe upwards of $5,000 by waiting until age 70? Then in that scenario, if Jack were to predecease Jill would then step up to the $5,000 benefit, not the $4,000. So by delaying those benefits past full retirement age up until 70, you have the maximum possible survivor benefits, which could be really, really important based on your financial plan and based on your situation. So when you're looking at longevity protection, don't just look at it for you, but also look at it for your spouse as well if you are married. All right, number 5 we put in here is tax efficiency. This is one of my favorite ones. You know how I feel about taxes. I want to reduce all of our clients' lifetime tax bill. In this scenario, I want to talk first about Social Security taxation. Okay. So Social Security benefits may be taxable. They may not be taxable. They may be partially taxable. And it's all dependent on what they call your combined income, also known as your provisional income. And really, in short, the way they calculate this combined income is they just take your adjusted gross income. Okay. Not including Social Security. So they take your adjusted gross income. So maybe it's income from IRAs, or maybe it's capital gain distributions, or maybe it's interest income. Okay. So they take your adjusted gross income, or it could also be part-time wages, pension income, etc. So they take that adjusted gross income and then they add back tax-free income, basically income from municipal bonds. Okay. So if you have munis and you're trying to outsmart them and say, oh, you know what, I'm not going to show any of this income on my tax return. It may be tax-free at the federal level and even at the state level on your federal and state returns. But for this particular calculation, just like IRMA, they add back that interest income from those tax-free municipal bonds. So they add that back. So AGI plus tax exempt income, and then they add half of your Social Security benefit. Okay. So if you look at this chart here that I put on the screen, if your combined income, if you're a single filer is less than 25,000, zero of your Social Security is taxable. If it's between 25,000 and 34,000, up to 50% is taxable. And then if it's over 34,000, up to 85% of your Social Security benefits is going to be taxable. If you're married filing jointly, it just increases the numbers slightly. It doesn't double, but if it's less than 32,000, zero of your Social Security will be taxable. If it's between 32 and 44, up to 50%, more than 44, up to 85%. So I say this because at some point in time, your income might drop significantly, especially in the early phase of retirement. Okay. And you could elect to take Social Security right away in conjunction with IRA distributions or even doing Roth conversions. But by doing so during that period of time, let's say you are aggressively converting to Roth during that Roth conversion window is what we like to call it. So the Roth conversion window, for maybe those of you that are new, we basically call this the period of time at retirement when your income drops up until you hit RMD age, required minimum distribution age, which if you're born 1960 or later, that would be age 75. If before then, it's be age 73. So let's say you're retired at 60 or let's say it's 62 because we're using Social Security as an example. So let's say you retire at 62, you're eligible to take Social Security, but then you have a Roth conversion window from 62 to 75, and you also want to aggressively convert to Roth. Well, if you start Social Security at that point in time, those Roth conversions straight away will probably make up to 85%, probably 85% of your Social Security included in taxable income. But if you delayed Social Security, and maybe you started some distributions from your taxable brokerage account, maybe you did some Roth conversions aggressively during that period of time when delaying Social Security, and you're taking some distributions from IRAs, you haven't started Social Security, so now you have the benefit of delaying, and obviously you're relying on your investment portfolio more. But now you're converting those assets over to Roth, and all of a sudden you hit that RMD age, and you have very little to no required minimum distributions. Now your Social Security might be 100% tax-free potentially, depending on what other income sources you have, or maybe a very small portion of your Social Security income is going to be included in your taxable income. So it's one of those things. It's definitely a game to play and some numbers to crunch to kind of make sure, hey, does this plan line up? But we've got a client that's in exactly that scenario where she retired at 62. She's going to delay Social Security. We're taking distributions from retirement accounts right now, and we're converting to Roth, and she's taking an annuity income stream. Well, once she hits that RMD age, and she's going to start taking Social Security at 70, well, once she hits that RMD age, very little, maybe even no income, none of her Social Security income is going to be included in her taxable income. So essentially we're delaying Social Security, and we're going to make that Social Security income tax-free on the back end. So again, the tax game is definitely something to consider because of some of the cool rules within the tax code there. Number 6 I put in here is maximizing legacy. Now this might confuse somebody, okay? Because if you kind of think about this on paper, if you listen to the episode 68, I talked about taking early and investing aggressively to maximize legacy. So you're kind of thinking, well, you're talking out of both sides of your mouth here. Well, if you don't have the risk appetite, or if returns aren't as good as you think they might be, well, if you delay Social Security, certainly short term, you're going to put a little more pressure in your portfolio. Okay. You're going to put a little more pressure with more aggressive rates of withdrawals. But if you have longevity, if longevity is in the cards, okay, if you take care of yourself, you have good routine, maybe your spouse is also healthy as well. So there's a good likelihood that one of you is at least going to live into your mid 80s, maybe even 90s. Well, once you start Social Security, start that higher benefit, now your lifetime rate of withdrawal is going down. Okay. Because again, yes, you might have an 8-year period or a 5-year period of higher withdrawals by delaying Social Security. But once you start that Social Security payment, you have a higher starting point, and that might last 15 to 20, even 25 years. You could reduce your lifetime withdrawal rate and ultimately maximize that legacy that you leave behind. And I illustrated this in this example. I looked at a client that had about $1 million. I think this is actually from one of our whiteboard fireside chats back in the day, but $1 million starting point. And the blue line is both individuals claiming Social Security at 62. The orange was claiming at 70, and then the green was actually a hybrid, one claiming at full retirement age and one claiming at 70. Okay. But essentially, the blue line, you can see the impact on those investable assets by claiming right away. It allowed that portfolio just to continue to grow over time because they were both claiming at 62. They didn't need a ton of income from the investment portfolio. So on the surface, you're like, oh, this is great. The investment portfolio is growing. Well, look what happens to the green line. Okay, so the green line, that's the optimal plan in this scenario where one delayed until full retirement age and then one delayed until 70. Well, look at that scenario. The investment portfolio did take a dip early on. Okay, but then what happened was it went through a significant recovery period because the much higher Social Security benefits starting at 67 and 70 allowed for that portfolio to recover pretty aggressively. And at right around year 22, so in that scenario, they would be around age 84 at that point in time. The portfolio far exceeded, especially at death, far exceeded what that investment portfolio would have been if they had claimed at 62. So again, if they died early, if they died in this period from year 0 or upwards to age or year 22, absolutely, they would have left a smaller inheritance behind. But ultimately, if longevity is supported and rates of returns are reasonable, they could definitely leave a higher legacy by delaying Social Security a little bit, despite a much higher rate of withdrawal during those early periods. Number 7 I put in here is just a simple peace of mind factor. I think this is a big one. This is a big reason I see individuals work a little longer than they probably need to. Maybe they're 62, maybe you're 62, maybe you're 63, 64, 65. You're eligible for Social Security, but it's kind of like the Medicare decision. You're like, you kind of want to hit that magic age of 65 before you retire, even though you can buy insurance on the exchange, even though you can buy private insurance, but it's just kind of, it's like embedded into your mindset that, hey, I should probably delay Social Security as long as possible to 70 because it's going to give me the highest possible benefit amount. I have longevity in my family. I want to protect against inflation. I want to protect against longevity. The simple fact of you have a much higher guaranteed paycheck, it just allows individuals to sleep better at night, knowing that they're going to be relying on their investment portfolio or their variable investments less for their retirement income. I think this is a big factor. Number 8, I'll throw in there. This is more of like a nuanced one, which is health savings account eligibility. So HSAs, as you know, if you listen to this podcast for a while, one of my favorite accounts for retirement planning. It's got the triple tax benefit. You've got the tax deductions up front, tax exempt growth over time. And then on the back end, assuming they are for qualified medical expenses, the distributions can be tax free as well. Okay. So many of you love HSAs just like myself. Well, if you're eligible for an HSA, regardless if you're working or not, once you turn Medicare eligibility, so once you're 65, if you enroll in Medicare, you're no longer eligible to contribute to an HSA. Okay, so that's very important to note. Even though you're on a qualified employer-sponsored plan, if you enroll in Medicare at 65, you are not going to be eligible to contribute to an HSA. And just for those of you that know, if once you begin collecting Social Security, you're automatically enrolled in Medicare after you turn 65. So there's no way around this. So once you're covered by Medicare, the HSA is no longer eligible. There's some complicated rules involved in this in terms of the timing, but just something to keep in mind. If you do plan to work past 65 and you're thinking about enrolling in Social Security and you also have an HSA, you really want to do your due diligence before you do that because it could impact those contributions, especially if you plan to work from 65 to maybe 70 or 72. That's going to be a significant impact on those contributions over the next handful of years. Number 9, the one I threw in here is flexibility. Okay. So just because you decide to delay Social Security doesn't mean it has to be set in stone. Okay. So you can retire. Let's say you're retired at 65 and you're like, hey, you know what? I'm going to delay Social Security a little bit. I'm going to delay from Social Security. I want to get that maximum benefit. Longevity's on my side. So I'm going to get the highest possible lifetime from Social Security. Okay. Good mindset to have. And let's say you plan to tap on your investment portfolio a little bit more aggressively during that 5-year period. You could test the waters a little bit, see how the market's performing. If it's behaving, continue on. But maybe you retire into a downturn. Okay, maybe you retire into a market, heaven forbid, like '08. At that point in time, you may not want to put as much pressure on your investment portfolio by way of withdrawals. You can always decide to start Social Security at any point in time. Assuming you're eligible and you're beyond age 62, assuming you're eligible, you can start Social Security at any point in time. So even though you have the mindset to delay Social Security, there's always that flexibility to start a little bit earlier. And then I mentioned at the beginning, or partly in the beginning of the episode, that if you do claim at 62, on the flip side, if you do claim at 62, there is that flexibility where you can stop at your full retirement age. Maybe you went back to work and like, I shouldn't have claimed Social Security. You can stop it at full retirement age and then continue to delay that benefit till 70. So there is some flexibility on that side, but you only have that one window of opportunity at your full retirement age. Whereas here, delaying Social Security, you have that window to start Social Security at any point in time, and particularly if you retire into a bad market. Very, very important, because then you have that sequence of return risk that could really impact the longevity of your portfolio. So listen, every Social Security decision is going to be a little different. I mean, there's no one size fits all. I mean, there are hundreds of different claiming scenarios, because of the window of opportunity and when you can start benefits, married couples, survivor benefits, spousal benefits. There's so many different scenarios you can run. There's no one size fits all. But again, make sure to check out episode 68 of this podcast, which is 9 reasons to take Social Security early. And hopefully, if you kind of put both of these together, hopefully you can make the best decision for your situation, your family. Okay. And also remember, don't let emotions or what you believe might happen to the system drive your decisions. I get it's very easy to kind of think, hey, I'm not going to live long enough to make it worth it, or the system's not going to be there for me, or I need the money now. So, without thinking about your other assets or other cash flow sources, just starting Social Security, we see that time and time again. We see that mistake time and time again, which could cost you several hundreds of thousands of dollars during your lifetime benefits. But each Social Security decision should be really well coordinated with the other aspects of your retirement plan. Okay, so make sure you crunch the numbers. Make sure you're consulting with your advisors. And of course, if you want help with this and you're like, hey, Kevin, can we work with your firm? We are accepting new clients. You can start by filling out that retirement readiness questionnaire that's linked in the show notes, or you can just visit our website at www.imaginefinancialsecurity.com. We'd love to hear from you. We love hearing from listeners, and we'd love to help you achieve your desired retirement objectives, including coming up with the best Social Security decision for you. And if you have any comments or questions or things that you'd like to add to this episode, you can just drop them right in the YouTube section, drop them right in the Spotify episode, or you can email me at kevin@imaginefinancialsecurity.com. Would love to hear from you. And until next week, this is Kevin Lyle signing off.